Hey everyone, and welcome to this explainer. I am absolutely thrilled you're tuning in today because we are pulling back the curtain on a fascinating and, frankly, completely invisible machine. We're going to dive deep into the silent forces that are quietly, and I mean very quietly, draining your wealth right out from under you. If you've been working hard, saving up, playing by the rules, but you still feel like you're somehow losing the game, well, you are in exactly the right place. You know how you look at the news and the headlines are always saying the economy is growing, jobs are steady, everything is totally fine. But then you're at the grocery store or you log in to check your bank account and the math just doesn't seem to add up, right? Well, today we are looking right past those flashy headlines to see how massive global shifts and incredibly localized personal choices are quietly squeezing your wallet. We're going to break down 3 huge financial illusions that are keeping you stuck. All right, let's get right into it. Illusion number 1, the U.S. debt crash. $32,000. Now, let that sink in for a second, because that is exactly what the U.S. government borrows and spends purely on interest every single second. Literally, just in the time it took me to say that sentence, the government borrowed more than most people make in an entire year just to pay interest on old debt. The national debt is huge, obviously, around $39 trillion, but the size actually isn't the dangerous part. The dangerous part is this interest machine compounding so incredibly fast that the U.S. now spends more servicing its debt than it spends on its entire military. So how does that massive, abstract global debt land right on your kitchen table? Well, let's imagine a really reasonable institutional investor over in Japan. We'll call him Kenji. Now, for decades, Kenji parked money in U.S. treasuries because Japanese interest rates were stuck at 0. But recently, Japan actually raised their rates. Suddenly, Kenji can earn a totally safe return right at home. So he politely steps back, buys fewer U.S. bonds, and because there are fewer reliable buyers out there, the price of those U.S. bonds falls, and their yield goes up. And here's the kicker. American mortgages are built directly on top of those yields. So because Kenji in Tokyo made a totally boring, rational decision at his desk, your 30-year mortgage suddenly gets $130 a month more expensive on a random Tuesday. Because of chain reactions exactly like this, we've basically been conditioned to think a debt crisis looks like an action movie. Missed payments, panic in the streets, a fiery default. But because America literally prints its own dollars, a dramatic default just isn't going to happen. The government will always just print the money to pay the bills. So instead of an explosion, we get this really quiet, slow erosion of our purchasing power. The collapse is actually already here. It just looks like a slightly higher mortgage rate and a grocery receipt that quietly swallows up your annual raise. And this slow leak is part of a very deliberate strategy called financial repression. It's the incredibly boring, totally invisible tactic governments use to pay down massive debt. By keeping interest rates just a hair below inflation, the true value of the national debt slowly shrinks. But here is the ultimate catch. That debt is essentially being paid down straight out of your checking account. Your savings slowly melt away in purchasing power without a single vote ever being cast. You, my friend, are the repayment plan. Moving right along to illusion number 2, the shiny truck. $700. That is just the baseline, absolute average monthly payment for a new car today. And we're not talking about a luxury vehicle. That's just the average. If you look at the massive trucks and SUVs that absolutely dominate the roads right now, those payments are routinely demanding over $900 or even $1,200 a month. People are literally paying mortgage-level money for something that just sits parked in a driveway. So you've got to ask, how do people actually afford this? Well, the answer is they don't. They get totally trapped in this negative equity cycle. To make a $900 payment look somewhat manageable, lenders have stretched loan terms way out to 6, 7, or even 8 years. But as we all know, cars depreciate rapidly. By year 4, the buyer really wants a new truck, but they owe way more than their current one is even worth. So what do? They trade it in, and they roll that negative equity, the old debt, into a brand new, even bigger loan. They are sprinting on a financial hamster wheel, constantly paying for cars they don't even own anymore. Let's break down the actual terrifying math behind that shiny new truck, because when people buy, they really only look at the monthly loan payment, right? But let's look at the real numbers on a $55,000 truck over 7 years.
First, you have about $67,000 for the loan itself with interest. Then, you add $21,000 for comprehensive insurance, $29,000 for fuel, because let's be real, it only gets about 15 miles to the gallon, and easily $15,000 for complex modern maintenance. That brings the true out-of-pocket cost to an astonishing $130,000.
Think about that for a second. This isn't just transportation financing. You're spending $130,000 over 7 years for the privilege of driving an asset that, by the end of it all, is worth maybe $15,000. I mean, if you took that same monthly money and just dropped it into a boring index fund, you'd have built $70,000 in real wealth. Instead, it's total wealth destruction, completely masked by heated seats, cup holders, and this vague feeling of rugged independence.
And this creates such a powerful identity trap. The auto industry isn't just selling transportation anymore. They are selling lifestyle, identity, and status. People are willingly sacrificing hundreds of thousands of dollars in potential index fund growth just to project an image of success to the world. It basically creates what amounts to automotive Stockholm syndrome. People become emotionally attached to their financial captor, fiercely defending a truck payment that is literally robbing their future purely because driving something cheaper feels like a blow to their self-worth.
Which brings us to illusion number 3,
The millionaire.
It is wild to see how inflation has quietly relocated the ultimate financial finish line. When our grandparents talked about being a millionaire, it meant yachts, private islands, the whole shebang. But $1 million in 2026 buys roughly what $514,000 bought back in the year 2000. And if you go back to 1980, today's million has the purchasing power of just $246,000 back then. The word itself hasn't changed at all, but the math underneath it absolutely has. A modern millionaire is functionally identical to someone with a quarter of that wealth in 1980.
So let's look under the hood at the actual mechanics of $1 million today. If you apply the classic 4% retirement rule, $1 million portfolio generates about $40,000 a year in income. Guys, that's just the salary of a mid-career manager. Furthermore, for most paper millionaires, a huge chunk of that wealth is actually locked up in home equity, and you can't exactly buy groceries with your roof. And if the rest of it sits in a pre-tax 401k, well, the government is basically a silent partner, just waiting to tax it heavily the second you withdraw it. And then there is one final massive bill waiting at that finish line. The current estimate for what an average 65-year-old couple is going to need purely for healthcare in retirement is roughly $345,000. So a huge chunk of that hard-earned million is already spoken for by future medical bills before you even retire. It really proves that hitting $1 million isn't yacht money anymore. It's just a very nice rest stop on a much, much longer journey.
Let's pull this all together. Section 4, quiet wealth versus flashy debt.
Picture two neighbors. On one side, we have John. John has driven a used Camry for 30 years, quietly funneled his money into index funds, and systematically built $1 million net worth. His life is incredibly low stress. Now, 2 doors down is Todd. Todd has the leased luxury truck, the brand new boat, the absolutely perfect lawn. Todd looks 10 times richer than John. But Todd is dangerously overleveraged, and he is likely one missed paycheck away from complete financial disaster. True wealth is what you don't see. It's the car not purchased, the flashy vacation not posted on social media. This perfectly lines up with what the legendary investor Charlie Munger used to say. Building real wealth is not flashy at all. Munger noted that saving your first $100,000 feels like an absolute nightmare. It literally feels like pushing a massive boulder uphill with your bare hands, because your money is growing mostly from your sheer effort of saving rather than from actual returns. But you absolutely have to push through it until compound interest finally takes over, and that boulder starts rolling on its own. You know, John's superpower wasn't perfectly timing the market or picking the next massive crypto winner. Actually, his superpower was just patiently doing absolutely nothing for 30 years. Avoiding the car payment trap, ignoring all that macroeconomic noise about the national debt, and just letting a simple index fund quietly do its thing is the actual unsexy secret to surviving the financial squeeze. It's really about being the most patient, least interesting person in the room when it comes to your money.
And so, as we wrap up this explainer, here is the ultimate question. Now that you can actually see this invisible machine, now that you know the slow debt erosion is real, that the car payment is a massive wealth-destroying trap, and that the millionaire finish line is largely just a mirage of marketing, what are you going to do? Are you going to keep funding these illusions just to look rich to people you don't even know? Or are you ready to step off the treadmill, embrace the boring, and start building quiet, indestructible wealth? The choice is entirely yours. Keep learning, keep questioning, and I'll see you in the next one.